The river that cuts through rock does not do it by force. It does it by patience. That is the rule nobody likes. My greatest investing rule is not about what to buy. It is not about when to sell. It is not about forecasting the economy or predicting the next crisis. It is about restraint. Do nothing until doing something is unavoidable. This sounds simple. It sounds almost lazy. But I have learned that most financial damage is self-inflicted. Not by ignorance, not by lack of opportunity, but by the inability to remain still. Activity feels productive. Silence feels like surrender. And so people trade. They announce, they explain, they justify, they adjust, they chase, they rarely wait. In my early years, I believed intelligence required visible action. When markets moved, I moved. When others spoke confidently, I responded. When prices fluctuated, I felt compelled to demonstrate awareness. The market does not reward demonstrations. It rewards discipline. There were seasons when nothing was attractive. Prices were fair, sometimes expensive, enthusiasm was high, conversations were loud, predictions were optimistic. I waited. People assume waiting is passive. It is not. Waiting is preparation. It is study. It is building liquidity. It is observing management teams over time. It is understanding industries deeply enough that when price finally disconnects from value, the decision is not emotional. It is inevitable. Wealth is an invisible game. The true scoreboard is private. The loudest participants are rarely the ones compounding quietly in the background. Noise attracts attention. Attention attracts competition. Competition compresses margins. Silence protects them. There is something uncomfortable about silence in a world addicted to visibility. If you are not speaking about your moves, people assume you have none. If you are not broadcasting progress, they assume there is no progress. That assumption is useful. I learned long ago never to reveal my exact net worth, not because I fear judgment, but because numbers alter behavior. If someone believes you possess little, they treat you casually. If they believe you possess much, they treat you strategically. Both distort relationships. I once watched a capable investor share the rapid growth of his holdings in a public setting. The applause was immediate. So was the scrutiny. Competitors tracked his moves. Acquaintances proposed partnerships with unusual urgency. Even journalists began to construct narratives around his decisions. His capital had not changed. His environment had. Exposure is expensive. Money compounds best in privacy. Like roots underground, it strengthens quietly. Once exposed too early, it becomes vulnerable to imitation, to resentment, to unnecessary attention. Envy is subtle. It rarely presents itself openly. It appears as admiration with a question behind it. It sounds like curiosity with calculation underneath. Human beings measure themselves against others instinctively. When your success becomes visible, you become a reference point. And reference points create tension. I have seen friendships cool because one party advanced faster than expected. I have seen business partnerships fracture when outcomes became uneven. Not because of malice, because of comparison. Silence prevents unnecessary comparison. Another discipline I follow is never announcing my next move. The moment intention is declared, flexibility shrinks. Markets adjust. Counterparties reposition. What could have been accumulated discreetly becomes contested. I prefer to move in increments, quietly, deliberately. By the time observers recognize a position, it is already stable. In the forest, the predator that survives does not roar before it hunts. It observes. It calculates distance. It moves when probability favors success. Markets are no different. Information is leverage. I have spent decades refining how I evaluate businesses, studying capital allocation, management character, competitive durability. That knowledge is not for display. It is for decision-making. I have watched investors explain their edge publicly. Their analysis was impressive. Their advantage evaporated. Once insight becomes widespread, price adjusts. The gap closes. An edge shared carelessly is an edge surrendered. Patience is not inactivity. It is selective action. It is the refusal to swing at every pitch simply because the ball is thrown. In investing, opportunities are not evenly distributed. They arrive in clusters. Long periods of calm are interrupted by brief windows of mispricing. Those windows reward preparation. The greatest investing rule nobody likes is this: conserve your energy for the rare moments that matter. Most people exhaust themselves in the in-between. There were years when my primary accomplishment was avoiding mistakes. That may sound modest. It is not. Preservation is underrated. A single reckless decision can erase a decade of discipline. In nature, survival precedes growth. I have also been deliberate about inheritance. I have seen wealth dilute character when handed over without expectation. Guaranteed abundance can soften ambition. It can remove the necessity of struggle. Struggle builds resilience. Resilience sustains wealth. I never wanted resources to replace effort. I structured my affairs so that opportunity remains, but entitlement does not. Because wealth without discipline dissolves quickly. Another quiet rule: never broadcast charity, success, or personal pain. Public generosity often becomes performance. Public success becomes measurement. Public pain becomes analysis. All three invite commentary. Commentary distracts from focus. When I give, I prefer anonymity. When I succeed, I prefer stability. When I struggle, I reflect privately. There is strength in not converting every experience into display. Validation is intoxicating. Once you taste applause, it becomes tempting to design decisions around it. Investors begin to act for recognition rather than rationality. They seek headlines instead of returns. Recognition is temporary. Consequences are not. There were times when markets were euphoric. Prices climbed rapidly. Optimism felt intelligent. Sitting out felt foolish. I felt the pull to participate simply to avoid appearing cautious. I resisted. Later, when enthusiasm turned to fear, the same assets were offered at substantial discounts. The crowd that once rushed in now rushed out. Nothing fundamental had changed as dramatically as the price suggested. Emotion had. This is where restraint proves its value. If you have preserved capital during euphoria, you possess flexibility during panic. Liquidity is not laziness. It is stored opportunity. When fear spreads, I do not rush to act immediately. I examine balance sheets. I review competitive positions. I assess management integrity. If intrinsic value remains intact while price collapses, I move. Quietly. I do not announce purchases. I do not justify them publicly. I do not seek validation for courage. Because courage that requires applause is performance. I prefer conviction without audience. Being underestimated has served me repeatedly. When people assume you are cautious to a fault, they overlook your capacity for decisive action. They negotiate casually. They reveal more than intended. Underestimation creates space. Ego resists this approach. Ego wants to be known as bold, as visionary. But ego is fragile. Once identity is attached to constant action, flexibility disappears. Changing course becomes embarrassing. Embarrassment is expensive. Silence protects adaptability. If you know your exact position, you can adjust without spectacle. If your strategy is not publicly dissected, you can refine it privately. The invisible game rewards durability over drama. I have come to appreciate boredom. Boredom in markets often signals rational pricing. Nothing extreme, nothing urgent. Those periods allow reflection. They allow study. They allow capital to accumulate. When extremes arrive, fear or euphoria, the prepared benefit. The river does not carve stone in a day. It persists. It applies steady pressure. It accepts seasons of calm and seasons of flood. Investing requires the same temperament. My greatest rule remains: act rarely, but decisively. Protect information. Guard your numbers. Withhold your next move. Preserve your edge. Raise heirs who value effort. Keep generosity private. Let results speak through time. None of these principles are glamorous. They do not attract attention in the short term. They demand comfort with being overlooked. But being overlooked is freedom. When no one expects dramatic movement from you, you are free to choose only what is rational. When no one knows your exact strength, you are free to negotiate without distortion. When no one tracks your every intention, you are free to adjust. Freedom compounds. Over decades, I have learned that markets fluctuate, opinions rotate, narratives evolve. Human nature, however, remains consistent. Fear exaggerates risk. Greed exaggerates reward. Ego exaggerates importance. Discipline neutralizes exaggeration. If I have any advantage, it is not brilliance. It is temperament. The willingness to sit in silence when nothing demands action. The patience to wait for odds to tilt meaningfully. The refusal to expose strength unnecessarily. Time rewards that posture. The loud may appear powerful for a season. They attract followers. They dominate conversations. But conversations do not compound. Capital does. In the end, my greatest investing rule is not complex. It is uncomfortable. It requires resisting the urge to participate constantly. It requires ignoring the need to be seen. It requires trusting preparation over impulse. It requires silence. Because wealth grows best in the shadows, away from applause, away from comparison, away from noise. And the strongest investor is not the one who moves the fastest or speaks the loudest. It is the one who can sit quietly while the world rushes, and act only when the moment truly deserves it.